This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name is Andrew Page, founder of strawman.com, and I'm joined once again by Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
And Claude Walker from ethicalequities.com.au.
Bonjour.
Oh,
bonjour.
I like it. A big show this week, a big week, in fact, for the markets. And how can we start anywhere else except for the Banking Royal Commission? So we'll kick things off with that. But Claude, what are we going to also talk about?
So we tried to stop Andrew, but he insisted that we talk about his favourite stock of all time, Catapult.
Let's not exaggerate. Favorite stock of all time?
Sorry, that's Envirosuite.
Well, we'll talk about that too.
There. Okay. Well, I've covered both of them then.
Too. We have to. There's been a bit of an update there, so we'll touch on what's happened with those two businesses. And finally, Matt, what do you want to talk about?
I'm going to talk about China and its Great Wall of Debt.
Ooh.
And what it might mean for Australia. Yeah.
Okay, that sounds
So
ominous.
the takeaway is, if you are playing the Three Wise Monkeys drinking game, which is you take a drink every time we mention either Catapult or Pro Medicus, then I hope you've had 2 sips already.
Okay, so Claude, I'm going to throw this one to you, and this is the big one.
I hope it's an easy one.
What do you think of the Banking Royal Commission?
All right. So, well, I guess I should start from the belly button, as it were. Obviously, people know that I hedge against the banks. So when the bank share price goes up 5%, my puts pretty much go to zero. So I lost about $600 on that today and had to buy some new puts. So,
okay.
That was a bit annoying.
It's not all about you, though.
Obviously, there are some ramifications for society
there
or
you go.
something
That's
like
the
that.
feedback. That's the implication.
But
I lost
That's the
$600
impact on the Australian
Look, I would be
economy.
lying if there was like anything else at the forefront of my mind today, other than the fact
puts,
that
okay.
my hedging position just went to about zero.
Yeah, all right. Andrew, do you want to give us an overview of the Banking Royal Commission?
I'll try.
Report
For those
came
that
out
missed,
with it.
that's all of the bank share prices went up like 5% or something.
Well, look, the Banking Royal Commission, it's been really hard to avoid this. It's just dominated the papers. It's been a long-running process. So I don't want to get too deep into the weeds here. I think anyone who's got even a half interest in this will find a lot of really, really, really good analysis here. But we thought we can't really do a market-based podcast and not discuss it. We've talked previously how Claude especially, certainly not keen on the banks. So I guess we've got less enthusiasm for really diving deep into the weeds. But look, Mr. Hayne handed down 76 recommendations. The banks rallied because, frankly, they were potentially braced for a lot worse. And of all the things that came out, there was nothing really new in the final report to my eyes in terms of what was sort of very strongly indicated in the interim report pretty much came out. People tend to think that it's been a very worthwhile exercise. A lot of good recommendations have come down. Both sides of government have said that I think largely they're on the same page here, barring 1 or 2 items that they're going to try and enact as many of these recommendations as they can. Could have they gone further? Yes, they could have. A lot of people are arguing that they should have continued with forcibly removing the vertical integration of banks, maybe doing more to limit executive pay.
So vertical integration, you mean the...
So that's when you own various parts of the industry. So you might be in typical banking, but also do wealth management, and also do insurance.
Maybe giving some advice to buy the same products that we sell and that type of stuff.
And it's a very conflicted kind of area. So
I think
people for good reason talking about that
If
kind
I'm
of
not
stuff.
mistaken, I think one of the things that I thought was really interesting was the suggestion that when an advisor is in some way conflicted, the law should change from the current status, which is if the advisor's conflicted, then they can't say they're independent, to specifically having like
saying why they're not independent and explaining
exactly.
why.
It's a subtle but important
the
difference.
commissioner
Right?
Kenneth Hayne, who used to be a High Court judge, he sort of said this should be prescribed, even like the way in which they say this, which I actually think would be a really good thing. I think it would be really powerful if, as part of the sales process, the conflicted advisors had to get people to sign a statement that quite clearly stated that they understood that the person was conflicted. I think that's really important. I mean, even today, I was called by our old insurance broker people who wanted to do the yearly review. And in order to review my insurance situation, they want to charge me $900 fee for service, which, you know, I don't mind paying a fee for service. But then I was like, all right, can you just include in your email, like, whether you get commissions from products as well?
Yeah.
And then, of course, they do get commissions as well, which maybe they're going to rebate or whatever. I don't know. Yeah. But the point is that already they sort of lost me. I'm like, yeah, I'll pay you $900 if that's it, and there's
high
nothing
quality
else.
Independent advice.
Yeah, but if it's $900 plus you've got deals on the side,
if it's not a boilerplate template for something they rocked out 500 and took them 5 minutes to put together,
I would pay $900 for like someone to really do the market research for me for something important like life insurance.
Sure.
And as long as they're not also getting a commission, basically.
Well, let me say this. So the banks went up. The banks were like, that could have been a lot worse for us. Mortgage choice, mortgage broking, that is a very different scenario. Though their very business model, I suspect, is under threat. And the market seems to have some pretty big concerns about it too, because shares were down 25% today.
And so their model's under threat because the banks can no longer pay them a commission.
Yep.
It has to be kind of upfront payment that they receive from the borrower, I guess, is the intention.
And here's the thing. I've been seeing there's some really good mortgage brokers out there that I've seen on Twitter basically making this case that actually we provide a really good service that's in our interest to do. And I actually agree with them. But why I think the market is so legitimately worried is the psychology is very different. One, the fee was always coming out of your pocket, not indirectly, but that's ultimately where it came from. But psychologically, it is massively different when it actually comes directly out of your pocket.
Yeah, but I think it's really important because mortgage broking industry is not built around people providing a valuable service. It's built around people being the salesman for loans, which is why they were remunerated as the salesman for loans.
Potentially because they might get better commissions with one product than another.
But
which
also,
might
it's not just that.
Suitable.
It's like if you remunerate a salesperson by a commission, whereas somebody who is an expert that has advice that they want to sell, they build their business on giving advice, and they have the relationship where the client values them.
Yeah.
Which, you know, we have all had at one point or another.
Yeah.
And that's a completely different relationship and a completely different skill that you're honing is in terms of the relationship with people versus when you're just trying to like get a product out the door.
Yeah. But when it comes to financial products, and you know, a lot of these things families might deal with once or twice in their lifetime. They don't have the background, you know, and I found that when we bought a house, we actually used a mortgage broker, and he was great. He just basically, as you said, he just did a whole bunch of legwork, presented us with a whole bunch of options. It was really great, you know. And I actually took the view, it's free at the time. But if someone had turned around and said, "Hey Andrew, do you want all of this? It's going to cost you $900 for the sake of argument," I probably wouldn't have. Probably would have thought, you know, I value what you do, but I can also do it myself. And I think a lot of people will.
Yeah, but if there's no commission, I think people will still, like, some people will pay it. But the problem is it's fewer people.
Not far fewer people. I agree with you. People will, but far fewer. So this is why it's such a massive hit to that industry. So that was one really, really big thing. Others will also argue too that, ironically, what it does is going to consolidate power to the big four because structurally there's not too much changes there now. A lot of these ancillary financial services are now gone. And so maybe people will just be dealing directly with the bank. They're actually going to get a little bit of extra margin now because they don't have to pay... pass that on as a trailing commission, and call me skeptical, but are they going to pass that in full along to the customer, particularly given the competitive dynamics? So there's good reasons for the market reactions today.
I think it will be interesting as well because mortgage brokers obviously had, well, according to like various sources, including, Tepper and Hempton, sort of research analysts, short sellers. According to them, the mortgage brokers have had a huge role in sort of playing down people's costs and helping them get bigger loans because it was in the mortgage brokers' interests to basically have someone borrow more because they get bigger commissions. And I think that is really why mortgage brokers deserve what they're going to get because, there's a valuable service. And for the people that could resist taking on a bigger loan than they should have, mortgage brokers probably provided a valuable service. But then there's some people who don't know their own limits and the mortgage brokers were trying to push them to their limits and past the limits. And I
You've
think
got to look at it systemically.
There's a-
Yeah,
there's
there's like
this-
two different things, isn't it? So the mortgage brokers probably push much bigger loans and risk of financial distress. But if it's just the big four, probably just overall less of that, but maybe worse rates for everyone. It just kind of becomes less competitive. something
Yeah,
like
that exactly. And I think that that we will sort of lose out in a bit of less competition. But for those people that want to shop around, you'll always find some people that are trying to compete.
Yeah.
It's just that I think it will overall become less competitive now, and people are more likely, if assuming all of this actually gets enacted and stuff, who knows how it's going to interact with the property market, which is sort of still on its merry way down.
That I was going to raise that up, and that is really interesting because it must have been a consideration for the Royal Commission that if things are too punitive here, for the best of intentions, for the best of reasons, he might have wanted to make some really important structural reform. But at what price? I mean, could have you done
look,
this and destroyed the Australian
I don't actually
property
know about
market
that.
and with it the economy? So it needed to be a delicate touch. I think that as much as I would like to see things like the commission go even further in its recommendations, I'm very mindful that you can be too ideological. With this
Yeah,
stuff
I don't know
and
what people expected. I find it Kenneth Hayne, was a not activist judge. He was a very black letter law judge, and who many would have considered more on the right. Like the government picked their commissioner, and I don't think there was ever a risk that it was going to be some sort of radical set of recommendations. And by all means, I think he's done a great job, but I don't think that it's true that he wanted to go further, but he was worried about.
No, I'm not. I'm saying that there must have been a consideration.
I'm sure he
is
would
what
have done.
saying,
I'm sure he would have said
and
exactly
it's also,
what he
and these
thought.
are just recommendations. The government's got to sort of legislate for all of this too. and
I
that would be a
highly doubt that
very,
the
very
commissioner
big
was like, "Oh, I'm
consideration.
worried about house prices." I'm sure that he just said exactly what he thought,
Yeah.
according to the,
The other
terms of
perspec-
reference that he had.
The other perspective that sort of seems to be out there at the moment is that a complete waste of time. We actually had pretty good rules. Yeah, that there was all this trouble that happened, but it's more a fault of the regulators themselves and things. If things were always just properly enforced, and maybe the penalty steepened, that alone probably would have. We knew that things were really bad anyway. These recommendations sound, in fact, a lot of them are legitimately good. A lot of them sound good. But when we fast forward 10 years, and this is a distant memory, is structurally the system that different that it's not going to allow for a lot of these things?
It totally depends on what happens next. Like, given that it's quite likely we'll have a Labor government in, given that obviously financial institutions have done a lot of things wrong and pretty much without fear of reprisal against any individuals, I think we could actually see some better, stronger legislation come out of this that will then protect people in the future.
So if there's still, as you say, there's still, the government still has to take action here.
Yeah, so
and Labor and
let's
Liberal
just
are both posturing.
nothing. This government's not going to do anything, right? It's all about
Well, they
what
said they're going to.
this government is an irrelevant. Come on, like
I've been doing this long enough that I don't get political.
I'm not political. I'm just saying, like, this is the fact. Like, even if you love Scott Morrison and think he's the best prime minister we've ever had, he's very unlikely to win the next election. The odds are at $1.20 onto Labor, right?
Yeah.
So,
But I guess where I was going with it
since
is
they booted Malcolm Turnbull,
is
and then
that-
he got replaced by an independent.
We're wandering way off script here. But what my point was is that these
How much could it- yeah, will it
recommendations,
actually change?
what is actually going to change, and yet the market seems to it would seem very early days, but it seems to be like, we're all past it all, back
So
to
I'd
the
actually,
trough.
I'd invert that view. I actually think things will change, more likely to change longer term. I don't think much has changed now. And longer term, because the bank's image has taken such a beating. I think they're actually pretty well respected in Australian society, at least me arriving in Australia, never really heard anything too negative for such an oligopoly. And I think it's been really
Everyone
tarnished.
hates the banks.
I don't think so. I don't think it
Everyone
was.
says they hate
not,
the banks.
Not like they do now,
Yeah,
I don't
right.
think. Like now you have all the stories that have come out. I think that has opened the doors to a lot more regulation, I guess, in
Yeah.
future.
Yeah.
But I just don't think too much has changed now. I think the lending is still just as crazy as it was.
Yeah.
I went to see the bank a few
goody.
weeks ago to see how things were looking, and I won't name which bank it was, but it was one of the big four, and I was definitely encouraged to submit a low expenses of like estimated expenses, and I was kind of like I was the opposite. Where I was like, no, we eat out. We're gonna spend more than that. Like, but think about what you will be saving once you do have this big loan, and you'll be so much
what
more.
What if you just ate 2-minute noodles?
Yeah.
Your house
And it's just so bizarre. I was just thinking that I was expecting the opposite. I was kind of interested just to see how much things had tightened, but no.
It's super interesting.
So it's still further to go.
I think
in that regard.
I think this is the reality of the situation. There's a big song and dance about banks tightening and all this sort of stuff, but they'll still lend you a lifetime of servitude.
Yeah, I think it would have been like a really nice, not a silver bullet, but I think when you put individuals, you expose them to criminal litigation. I think that changes.
That's what changes it.
That changes it, because at the moment, like if you get, if you do something a bit naughty, you might lose your job and your bonus, and maybe the company pays a bit of a fine. But it's a cost of doing business. If you want to take a cynical view, if the CEO can go to jail, or whoever executive is in charge of that, and you can prove that they deliberately, willfully did something wrong, you're going to jail for 10 years. I would imagine behavior improves really radically after that.
Yeah, nice.
So I think if it's safe to say, no one here is racing in to buy bank shares anytime soon, despite what the market's initial reaction is. Is that a fair comment?
Yeah, that's fair. I think a lot of other macro views that I have, at least for me.
Okay. Yeah. Well, we know what you think, Claude.
Yeah, I think they're a problem.
Mr. Burn it to the ground because I'm short.
Burn it to the ground. I'm just like, I'm the only one here that owns property. Like.
All right, well, we're going to talk about next.
I think you're going to talk about a couple of companies.
Oh, okay. Glasses at the ready.
News,
Which you want to start with, the good one or the bad one?
Okay, very quickly, I'll just direct you back to the podcast that we did on Catapult, and I think it was worth mentioning because they did preliminary results.
Wait. What has the share price done since that podcast?
It's down around 20% or something like that.
All right, so it's down.
Good thing I'm not a trader, Claude. I'm all about the long term here.
Long term
page, they call me.
I had a friend once who said a long-term investment's a short-term investment. That didn't work out.
Love that. That is fantastic. So yeah, without rehashing all the detail here, it was very interesting. It was a mixed bag, but I was actually encouraged by it. So when you look at, again, we've talked about how they sort of segment out between their core operations and the new prosumer ones.
Yeah.
Core operations, it did really well. 26% growth in revenue there. And by the way, they did that with only a 5% increase in OPEX. So there's, it's an early.
So the core is the professional sports and video analytics.
Yes. Yeah. Yep. All the wearables devices.
Not the prosumer.
Not the stuff for the sub-elite athletes.
Yeah.
Who are athletes well beyond any of our capabilities.
That's not what they call them in marketing either. Are you a sub-elite athlete?
That's right. Yeah, that ain't going to sell.
Do they call them prosumers to them face
prosumers,
it? You're
yes.
a prosumer.
You're a prosumer.
Professional consumer.
So that area's gone really, really, really well. In fact, they got a bit of a free kick too with currency gains as well. So when you look at currency gains, the revenue was up 32%. Mm-hmm. That's interesting because they had some pretty ambitious targets for that segment, and they're actually ahead of that pace at the moment. So based on what they said they should be able to do for the full year, I think they're very, very much on track. Given where their strongest quarter tends to be, I think they're very much on track to beat that, which looks good and is a core part of my thesis. What was interesting was that the prosumer side of things, they saw a doubling of units sold. They saw a doubling of their revenue there. Only problem is they had previously guided the market to expect 3.5 times to 4 times uplift in that. They had a really disappointing December quarter there.
So they doubled from 1 unit to 2 units.
They had to
100%, baby, 100%.
No,
they had to justify all the money they've been wasting on it.
They had to grow a lot faster than that to be close to successful.
Absolutely. Right. So why is that good news? Well, it's not good news. In a perfect world, that just would have worked. And by the way, it's a legitimately huge market. Someone will win it at some point, and someone will make a lot of money from it. But they haven't executed well. So given that hasn't worked out, the next the worst thing that could happen is that they just doggedly just continue to throw huge sums of money at to try and make it work and just basically, waste a whole bunch of shareholder capital. What was interesting is reading between the lines, and perhaps
whole
you don't
bunch
have to
more.
read too much between the lines here. They indicated very, very strongly that, well, in fact, they said that we're reviewing our investment in here. We're going to cut about $3 million in costs out of this area. We'll have more to say when we report our half-year results in February, which I took it to mean they're going to put a bullet in this thing. Either it starts to really, really perform in the next little while, or they're going to put a bullet in it. And that is good news, because the core of my thesis is, everyone at home would know, is that once you strip that out, you are left with a far, far stronger business, and one that is worth a lot more than I think it's worth at the moment.
Yeah, nice. It kind of suck if you're working in that division reading that update and you think,
what do you mean you're reviewing your investment?
What's that about? So I think I think the move away from trying to win the prosumer is probably the right call at this stage. I get the big picture why people were excited about it a couple of years ago, but they haven't been able to execute it very well. It's a very different model of selling, to go out and sell to consumers. Yeah. And I think the world started to change with like Fitbits and Apple Watches. We'd talked about this before, but there becomes more a possibility that your product becomes a feature of another product, And obviously it's not there yet. They have better hardware and technology. It's just whether that could come over the next few generations.
But as you say, it's a different market. I mean, the sales, the whole sales process is very, very, very different as well. And it was just it was an overreach, and it was done too soon. And for all in some ways, you can see the argument. Remember, they said, we've got the technology, right? We've got the IP. All we need to do is just make a pared down version. We can sell it to prosumers, and just huge amounts of synergy and all of that other kind of stuff. Which, well, it turns out that doesn't seem to be the case.
You've well done on the bull thesis. I think.
Here we go.
So the first thing is, there's a lesson for me here. When I first, at a certain time, I was an advocate for buying Catapult shares, and once they sort of announced this foray into prosumer, I was very slow to realize how bad that would be. And so I took losses when I should have sold quickly. Mm-hmm. So mea culpa on that. Secondly, I've heard this, or variations of this thesis, not just from you, but from other people that also like Catapult. It's basically saying, look at the segment profit.
Oh man, put them in touch. Misery loves company. I need to chat to these.
You know
guys.
them.
I love a bit of confirmation bias.
Look at the segment profit of the elite wearables thing, which I think Matt might have a view on that particular point.
Yeah, so I think my big problem with it is DA. So everyone talks about EBITDA for this company, but it kind of ignores that. So EBITDA excluding depreciation and amortization. Yeah. But there's a very
it's not cash.
So everyone adds up those and goes, "Oh, this is a great business. Look at all this EBITDA it's making."
And they're what are they saying? Like around 12 million in EBITDA this year.
Maybe even a bit more. And it's very big. It's almost as big as their cost of goods sold. And I think the reason is that this is mostly hardware, or it's a very hardware-heavy business, which then that cost needs to be spread over subsequent, periods. Yeah. So it's just something to keep in mind, that it's a very large segment of cost that doesn't get accounted for there. Yep. And then you've got this big corporate expense, which is over 10 million. I'm not sure how much
I think that's killer. So you've got, this is the one that I love. Now, the EBITDA point is beautiful. Thank you for that. But the corporate expense one is just the absolute bit of logic that should catch in your throat, if you like, the company, because this is one of those.
You should choke on that.
This is one of those either or things, right? Because either there are expenses that should probably be put in one of the segments. We don't know which, but we do know
it's very hard to really understand a segment.
Yeah,
because they don't split it up. Yeah.
But because these corporate costs are so high, either there are costs that really should go in a segment, in which case the segment profits are not as good. Now, if it's costs that really should be in the elite wearables segment, then the whole part of the business that everyone says is so valuable is probably actually less valuable. Mm-hmm. So that's not great. And then, so that's one possibility. Or, come on, how has a company this size got corporate costs along that? Like, just compare the corporate costs to Pro Medicus or something.
Totally. Yeah, I agree. Yeah. It's ridiculous.
So,
very poor
so either they're profligate, or one of their businesses, most likely the elite wearables, is actually not as profitable as it would seem.
I think the best outcome is that they're profligate, right? Because if the businesses themselves are not that good, then you've just got these businesses that aren't very good.
Buyers at today's price are literally hoping that management who they think are profligate will kill one of their profligacies, which is this whole prosumer thing, and do so, with minimum fuss in the quickest possible time, and then B, magically pull in their belt.
Yeah. Again, we said we weren't going to re-examine the whole thesis. All I'm saying is the core business continues to go very well, and they've made very strong indications that they're moving away from that. So make of that as you will.
That core business will be able to continue to fund their corporate costs for many years to come.
Look, I'll just finish by saying if they hit their full year guidance, which I've just reiterated to say they would, and you can thumbsuck maybe a 15% growth in annual sales over the next couple of years, which is slower than what they've historically done and still very much the early part of their journey. Even if you expense every single last cent of depreciation and amortization, even if you account for every single corporate cost that's in there, you've still got a business that is fast approaching break even. It's still going to be at a loss, but in 2021 they should be. In 2021 they actually have some real potential to do it. So again, there it is. I thought I'd update you guys on that. The other one that I wanted to update on was Envirosuite. So we talked about this before as well. This had a 30% pop the other day, which sounds fantastic, but these guys do this just on an average day. It's so thin and a liquid. But what was
it's up significantly since you first talked about it.
It is.
This one more than makes up for your Catapult tip.
Yeah. Well, look, I don't think this has played out yet, and I'm not in any rush to sell whatsoever. I still think it's cheap. So basically, as if you listen to the first episode that we did on Envirosuite, you know that they had some very ambitious targets. They're wanting to sort of double their recurring revenue this year. That would be $6 million. Towards the end of last year, it looks like they're a little bit below pace. They came out, they updated the market. They've already secured $5 million in annual recurring revenue as of the start of February. So they've got 5 more months to get $1 more million in there. So it's very, very, very likely that they will beat this very ambitious target, which is a really, 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 really great result. And just gives me some more strength in the company. The market was right to go up as much as it did. Say what? Sorry?
5 realies before great.
Oh, I should have added a 6. Almost dead.
Enjoy it.
I thought it was good too. I actually bought some shares, so I didn't have to watch you have all of the glory.
Should do the same for Catapult. Ching.
I will when they do some massive outperformance, like what it appears Envirosuite may have.
Let's say China. China, 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 China. You go over to China, 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 China. You take China. 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 I love them.
China.
Matt, China.
Yeah, absolutely. Yeah, cool.
Tell us about China.
Yeah, so I've just finished reading another book on it called China's Great Wall of Debt. So I haven't been focused on China for a couple of years. Yeah. So I thought I'd give a quick overview of, I guess, China and what it means for Australia.
It's like a quick overview of Catapult, man. That sounds hard.
It's a very mysterious country in a lot of ways because it's got a communist government that doesn't like to release a lot of information. So even the last 100 years of history, it's hard to find out anything true. But so it was an interesting book. Kind of a guy on the ground, and he's been living there as a journalist and wrote a book, which I wonder if he's still living there.
A Westerner?
A Westerner who had learned Chinese from a very young age.
Oh, great.
And kind of cross. So interesting book. And so I guess the big stepping back a bit for China. So it's been one thing that's quite mysterious is how it's been able to grow so fast for so long. And so I thought I'd just touch on that quickly. So there's a couple of components to it. And it's kind of known as the authoritarian investment growth model. Which is essentially you have a very strong government. So that's the first ingredient. This has been done many times before. I think that's the interesting thing. Mm-hmm. Every country that successfully adopted it has grown faster than the one before. Going back to like pre-World War II Germany, Nazi Germany did this model of very heavy investment. Right. Soviet Union did for a long time until it fell apart.
Is this what they call the so-called command economy?
It's similar to that, yeah. So essentially what you do is you have a very strong government because you need that to do the rest.
Do as we say or we throw you in jail.
And then effectively you confiscate effectively confiscate wealth from the people. And so you do that through a number of different ways. You have high taxes.
Is that called communism?
Yeah, no,
Sorry.
Communism would be just taking it,
Yeah,
and
sure.
then the next thing is what you do with it, I guess.
Right.
So you take the wealth, and there's a lot of different ways you can do that. You can not pay them a good interest rate, and then lend it out at a high interest rate. You can have your currency be super depreciated for a long time, so it's like that's effectively a tax on international consumption, right?
Yeah.
So all these things you can do, and none of them, you don't just go and take the money, because obviously you cause a revolt too much if you do that too directly. But you do all this, and you have a large pool of capital, and instead of that normally being spent on consumption, which is how most of the world would be driven by consumption, you put that into heavy investment. So that's the investment part of the investment-led growth model. And so that
And when you're saying, there's been various stages of this,
Yeah.
but I guess predominantly it was sort of in industrial output. that
Industrial
kind of
output,
stuff?
yeah. So the first big phase was export. So that's what everyone does. Japan did this as well until they came unstuck. So it's not
Right.
necessarily like a full-on dictatorship you need to do it. There's different ways you can do it. But you take all the resources and invest them very heavily,
Okay.
and you export that is normally what you do initially. So that's what China did for a very long time.
Yeah.
Up until about 2007, 2008.
GFC.
Yeah,
Yeah.
one was the GFC, so all that demand went away, and the other is at a certain point you become such a large share of the global economy that there's no demand out there to buy your products. So both of them, Japan
Is that
and
like an
China,
overcapacity?
it's kind of like it's just like there's only so much the world wants to buy basically. So if you get up to like over 20% of total exports for the world, there's only so much,
which is where they are.
yeah, which was where they got up to.
Yeah.
I'm not sure how that relative share breaks down today.
Yeah.
And everyone's kind of hit around that same limit, which is quite interesting. So Japan hit around
Wow.
the same limit.
Okay.
And so then at that point, you need to do something else. And so that's when China...
Airports,
yeah,
bridges,
exactly.
apartments.
Drove very heavy investment in infrastructure and created a vast wave of debt. And they've kind of never really got off that train since then. So
How do you get off that train?
It's a very good question. In a market economy, you'd have a financial crisis and wipe it all
Yeah,
down and
reset.
start again.
Yep.
And they've kind of been
Creative
grappling with that.
destruction
Yeah.
or something it's
So-
Friedman called?
Yeah, so China has more debt now than the United States. They've added over 150% of debt of GDP in the last decade. It's extremely fast, so it's growing much faster than GDP.
Yeah.
And that's how they're effectively growing. So
Okay.
it starts to hit a point, though, where you can't invest in anything productive anymore. And that's basically the state that China's been in for like 5 years now.
Right.
And it's just, I think, starting to hit a limit where it's not being directed productively, and so a large share of the new debt is going to just pay off the interest on the old debt, and so it's becoming less and less effective as they push down more credit. It's not creating the same economic growth.
Yep.
So now you kind of, if you could imagine a chart, you'd see credit continuing to increase and economic growth falling.
But that shouldn't matter. I mean, China's such a nice place to live with the social credit scores and all that
Yeah.
sort of
Freedom
thing.
of speech.
Yeah,
Yeah.
they're great. Like, you can be whoever you want to be.
Yeah, so it's a very weird country to like study and learn about. Like there's a department there which literally chooses the top 20,000 people in the country effectively, and there's cases where like
Top what?
even like all the state-owned enterprises. So like everyone, let's imagine an organization for personnel that chooses everything. It's just so obscure to us.
Yeah.
There's like literally a red phone on the desk of all the major companies that is a direct line into the Communist Party. Like it's just a different place for that kind of stuff.
It's like the bat phone almost.
It is. It's a literal red direct line. Yeah.
Okay.
So
A lot of people have raised China and debt and these issues before. In fact, going back like a number of years, and I'm the last person to say just because you didn't time it right, you were wrong.
Yeah.
But is the potential argument that they just muddle their way through for like maybe it's very dangerous and the rest of it, but even if there is an eventual reckoning, that could be 10 years away, right?
Yeah, so I think that it's becoming harder and harder to do that just because GDP growth is falling and they're continuing to increase credit, so that's a problem.
Yeah.
They're not like in other countries, so I think you shouldn't just like project. It's not going to be like the United States.
Yep.
It's a complete controlled economy.
Yeah.
But I just think that they're starting to hit that limit now. So we'll see if they can rebound again and get like good returns, but it doesn't seem to be happening. And their idea is to expand into new industries like semiconductors and that type of thing, but again, struggling.
So what's the ramification for us?
Yeah, good question. So China's a huge purchaser of one of our major exports,
I think
iron
it's
ore.
our largest trading partner.
Largest trading partner, full stop. I think the big takeaways for me is more caution around the consumer story, because I think that will suffer fairly directly. And I'd kind of been under a bit of a misconception.
So when you say consumer story, what you mean, the Chinese consumer? Or?
Yeah, so I haven't been invested in anything exposed to Australian mining for a while, partly because I don't like mining companies, and another because of the China risk. But I also see the risk affecting Chinese consumption. So one interesting takeaway from the book was that I'd kind of assumed that China's growth of consumption of food and tourism, etc., was like the middle class, the burgeoning middle class.
Right.
But China is actually incredibly unequal. And what I think we see is not really a middle class, it's like the elites. And there's just so many elites because it's 1 billion people that if you have, 2 million elites, they look like they're...
There's a lot of...
Yeah.
It seems like there's a big, healthy middle
and
class.
those folks would be struggling pretty tough if there is any kind of slowdown, because they're the same people that have benefited from it. So I guess that gave me a bit more caution.
Yeah.
And just that China is currently struggling with handling all this stuff. Like, it's starting to come unstuck a little bit.
Can I ask you a dumb question?
Yeah.
When you say they've borrowed a lot of money, where'd they borrow it from?
So it's mostly internal from their own banks.
So as a command economy, can they just say, sorry, your debt's defaulted, too bad?
To a degree, yeah. And they have kind of done that before in the late 90s.
Right.
It's just on a much bigger scale than it's ever been before.
But if you play that through, there's a lot of unhappy people within that.
Yeah, that's part of it.
Is it the social consequences and the risk to their legitimacy that risks, or is it just really painful, but we're going to do it anyway, and as a consequence, we're kind of okay. We can start up again.
In the worst case scenario, it's pretty dire. It's not just a drop off of imports, so we don't just rely on them for buying out iron ore and coal. They're big consumers of education services.
Tourism, third biggest industry.
They buy all of our... So we have built this incredible number of small flammable boxes in the sky, which we can sell for like...
also known as apartments.
we can sell for like $1 million each. Many of those, at least at the peak, a very meaningful percentage was to Chinese investors. There's a huge amount of capital coming in, and kudos for them to getting it out, because it's not easy. But that's capital coming in to an Australian developer that creates jobs to build flammable boxes in the sky. And that'll all disappear. That's all part of it. We also benefit from many talented Chinese people coming here and contributing to our society, which is probably in the longer term the best advantage we get, which hopefully will continue. But more to the point, if they start having internal strife, then I could see them getting more geopolitically aggressive.
Yeah, if you want to think about second order effects, I think that's a pretty big one. If there was any slowdown in the economy, it just seems to me like the most logical thing is to pick a fight over some territory where you can whip up national fever.
Taiwan.
And also have a huge opportunity for all that investment, heavy investment stuff to rearm, right? So that's it's kind of a dark scenario, and no one hopes it goes there. But
we're going to be in trouble for just even saying all this.
Well, there used to be that saying on the markets that when the US sneezes, the rest of the world catches a cold. It's got to be that times 10 with China, doesn't it? Like if they sneeze, like we just all fall down.
Australia is in big trouble.
Yeah,
Australia is in big
particular,
trouble. But the rest of the world, because they've just been providing demand to China,
right?
It's more like China's been benefiting from the rest of the world, if that makes sense.
But we've a lot of the rest of the world has benefited because we've got such incredibly cheap products.
Yeah.
If that gets taken away, is there an inflation angle?
No.
Who's going to make my $1 t-shirt?
This is not... You'll survive without... That's the whole issue, is that your $1... Like, the whole thing of this horrible, cheapened consumer society thing is it's not actually been good for anyone long term. It's actually hollowed out European and Western and Australian manufacturing.
I get that angle, but prices are going to go up though, right?
Yeah, but is it better to buy, one t-shirt every year for $10 or have one t-shirt for $30 that you keep for 3 years?
Do your t-shirts last 3 years?
My t-shirts do, but my t-shirts also cost about $10. So
Woo, big spender.
T-shirts probably aren't the best example here. But
Yeah.
yes, the whole point is I have to get rid of t-shirts because I get given free t-shirts and I've got too many t-shirts.
They're abundant.
Yeah, we've got to. I'm not going to suffer from a lack of t-shirt shortages, and neither is anyone in Australia.
No one's talking about the t-shirt crisis.
Have you not seen like the clothing bins? Like, go to any eastern suburbs
Fast
clothing
fashion,
bins,
baby.
and you'll like find this sort of, designer clothes dumped on the street.
So we've done it again. We've gone way off topic. So
The point is that-
round it.
I think that the issue is, aside from really bad stuff, they'll stop buying our imports, and that, or as much of our imports, and that
Yeah.
will definitely have an effect
Yeah.
on
It's
the
hard to
availability
think
of
Australia wouldn't have a recession.
the
at the very
availability
least
of
if-
jobs. But it's also, I think that the whole thing that's been underestimated so badly this whole time is how much property prices, or property, especially apartments, have been exported to people who probably don't even live there. Like, there's plenty of empty apartments, and then maybe some are just investments or whatever. But I've not met a great deal of Australian people who are excited about buying these new build
You know what?
apartments.
It's such a big topic and probably one for another day. But it's just, I know we've talked through it before. The problem always seems to come back to good quality data on that. There's definitely a lot of people making those noises, and then there's other people saying, yeah, but it's marginal. There's just as much. So again, we
It's
just
not
don't have the
marginal.
time to pick into that.
If you look at
but-
the surveys of who the buyers have been, it's been consistently above 10% for years now.
Okay.
It's
Yeah.
meaningful.
So I guess for me, it was kind of I had been quite bearish on China in 2016. They managed to just pump out a huge amount more debt,
Right.
and they went from 200 something percent GDP to like 320 or something. So they have done it before. We'll see what happens. I can't see them being able to do that same thing. It's clearly not working as well.
But
this
final
time.
thought, why not? Why can't they just pump out? Yeah, you're saying debt's not as effective.
Yeah.
And they had to go from, 100% to 300% to get the same effect as 0% to 100% or
Yeah.
whatever. But why is there a limit? Why can't they just go to 1,000% or 10,000%?
Is it? I'm guessing here, but is it like what we would think of when we're looking at companies making capital expenditure decisions? It's sort of like, yes, we've got a bunch of money that we can raise and we can put
Well,
into
I
something.
don't
But
think it is,
if we're getting
'cause
no
they can just-
or negative or very low return
They can
on
just
that,
lend it to themselves.
it's still there is a financial consequence inevitably.
It's tricky because it's one of these like theoretical things where there tends to be something that sparks any collapse, but in theory any collapse can go on for almost forever. To one thing is just the rates of return on their capital. So when they were investing before, it was productive and that was able to pay off a lot of it. So there would be pockets where they're effectively bankrupt and would have to just continuously lend. And it's not all state owned, so there's a lot of private businesses. that
What
would have to
happens
stay.
when a country just like continuously has to lend just to...
Yeah, so a few things. One is that you just starve out anything productive. So if you're all doing that, there's nothing tangible there. The other, though, is that there's also a lot of shadow credit, which aren't as controllable by the
Right.
government as they used to be. So that's a relatively large share, over 15% of debt created, is these banks and related to banks. So all that kind of stuff is... I've described it before as like an elephant riding a unicycle. Like, it's going to fall over at some point. Like, it's unstable, but you don't know necessarily when.
When it's going to
So
happen.
the really big question, will this impact PushPay or Pro Medicus?
I think
There it is. Just when you thought
it'll be pretty
the-
indirect
the
for both
drinking game was
with the
done.
international non-Australia market. So yeah, that's kind of what, a lot of our investing has been looking at companies that are very successful internationally and not dependent on the Australian market, right? Like I don't think any of us has a particularly high allocation to Australia in particular.
Very
So,
heavy
you know,
offshore.
I do have
On
a fair,
ASX listed, but offshore exposed.
fair few Kit McGrath shares.
One to think about. Guys, we've been going on way too long. Thank you both very much for your time again
Are
today.
you referring to us or the listeners?
I'm thinking
both.
like, thank
Both
you
Steve
to the
and
infinite,
Dave.
infinite patience of our two listeners. We hope you've enjoyed it. We'll be back again next week. Until then, you can always get in contact with us at the email address, which is
3wisemonkeys@gmail.com.
we love getting your emails, so please send them through. But until next week, I'm Andrew Page. Thanks for listening.
Claude Walker, thanks for listening.
And Matt Joss, thank you for listening.